Welcome to this update for the S&P 500, and I'm also going to be doing a bit of macro. So over the whole course of last year, we saw a controlled demolition in the S&P 500 as the Fed responded to a inflation problem by raising interest rates, leading to this controlled demolition, as I've put it. Now we're currently only 17% from the all-time highs as we now stand. And we just had the latest CPI data out, and that was actually negative for December. So although the attention is often on these year-on-year inflation results, I like to focus just on the CPI month to month. And in the third quarter, we'd had a low number for CPI increases, and I was wondering if that was a new trend or just a anomaly. Well, it looks like that is a new trend now. Perhaps the inflation was transitionary after all. When you look at the macro snapshot for the US, in complete isolation from the rest of the world, we have 4% GDP growth according to the GDP Now data. We have inflation apparently gone away, and so the Fed shouldn't have to keep on increasing interest rates. So looking at the data at this exact moment, this could be actually very promising for the S&P 500. There are some severe risks still. So taking a step back, and I've got here the long-term data for the S&P 500, and we have the dot-com bubble, we have the credit crisis, and we have the FANG crash as well. But generally, there are these linear uptrends in the value of the S&P 500, which makes sense because GDP tends to increase at around 2% a year. And of course, you have the effect of inflation as well. So these long-term linear trends do make sense. And of course, there was a steeper trajectory for the S&P 500 ever since the credit crisis. And ever since the credit crisis, that's when they started using this new Keynesian economics, where you have near zero interest rates for a long period of time, and there's also quantitative easing. So this was very effective in keeping the S&P 500 elevated along with GDP. So here we've got the NKE toolkit of low interest rates and quantitative easing, plus all kinds of government money handouts being used to meet the government objectives of low inflation, 2% GDP, and low unemployment. But of course, this has only been possible over the last few decades because of the deflationary environment we were living in. There's the growth of the internet, globalization, and new technology, creating a downward deflationary force, allowing them to get away with the loose monetary policy. But this did achieve this strong growth in the S&P 500 ever since the credit crisis. But then, of course, we've had the inflation problem over the last couple of years. Now, this is the Fed's initial dot plot of what they thought would happen with inflation over 2021, 2022, versus this is what's actually happened. And I brought this down to the energy crisis with high oil prices and the supply chain crisis caused about by government action during the corona crisis. This on top of all the government money printing and interest rate and low interest rates that were around already led to inflationary forces overcoming the deflationary forces, and then that's what then led to this inflation problem. But looking at this data here, it's clear that inflation may be going away. So I took a look at the US Bureau of Labor Statistics' latest CPI release, and it was interesting to see that actually most of the deflationary forces were all around fuel oil. And actually, when we look at the yearly numbers, and year on year, there's actually high inflation. But if we look at the yearly numbers, most of the problem comes down to fuel oil and energy. So actually, perhaps a lot of this inflation problem was related right down to energy, which then of course causes secondary inflation as well in other areas. So although right at this moment it looks like a good situation with low inflation month on month, but still low unemployment and good GDP sales growth, there is a risk that the price of oil could start going back up again, particularly now that China's reopening. So although things look set up good now, one risk is definitely that we get a resumption of oil price inflation. We get a resumption of inflation caused by the energy crisis. The US is the world reserve currency and it has a artificially strong dollar. But when we look at the dollar, it's actually been quite unstable lately. It was rallying hard last year throughout this inflation crisis. But as you can see, in the last few weeks, it's actually been plummeting. So now, of course, there's a good chance it will stabilize still above where it was back in 2020. But you can certainly say that the dollar is kind of a bit unstable at the moment. And when we look at the yield curve for the US dollar, it is inverted. So although it is perhaps a lower risk, there is a dollar crisis risk. Also, although the December numbers look actually quite good for the US, they've still got an inflation problem in Europe, and a lot of and around the rest of the world, things are going quite badly. So it could be that although things are great for the US for a while, a big worldwide recession problem throughout the world could then impact the S&P, then bringing it down. So at this exact moment, things do look good for the US. Inflation starts to appear like it was transitionary after all. And in terms of GDP growth and unemployment numbers, things that look quite good. But there are key risks, particularly there could be an energy crisis with the price of oil going back up, then causing inflation again. And this could then be like, a long period, of 5 or 10 years where you've got this continual problem because we haven't got enough oil. The dollar collapsing is another potential risk, and also a worldwide recession then impacting US GDP growth is another risk. So the fact is that in terms of the raw numbers that I've been tracking, there is scope that we could see quite a bullish S&P 500 this year. But I certainly still want to have a defensive portfolio allocation myself, because I still think there are some key risks here, and it makes sense to try and wait out a couple of quarters to see how this develops from here. Please remember that I do these videos just for fun. I have no financial qualifications or anything, so always seek help from a proper financial advisor before making any investment decisions. I hope you've enjoyed this video, and good luck. Please read the disclaimer and remember that prices can go down as well as up.